So if you're moving, and I mean, it doesn't matter if you're just swapping neighborhoods or you're, completely swapping continents, you know the feeling.
Oh, yeah. Information overload.
Exactly. You're just drowning in browser tabs, right? Everything from security deposits to global tax laws. Welcome to the deep dive, where we're going to try and distill all that into some pure, actionable strategy.
And that's so important because moving is almost always more expensive and definitely more complex than people think.
So what are we focusing on today?
We're pulling apart the whole spectrum. We'll focus on three core areas.
Mm.
First, the upfront cash you need just to get a roof over your head. Second, the huge cost of actually shipping your stuff. And finally, the really high stakes part, cross-border finance and tax.
And our mission here is pretty simple. We want to give you the key insights so you can spot the hidden costs, ask the right questions before you move, and do it with confidence and, without getting a massive fine later on. Okay, let's start with that first hurdle. The one that hits everyone, even if you're just moving across town. Getting the keys. It just feels like landlords want a huge chunk of cash right away.
They do. And it's so important that you understand where that cash is going. You have to distinguish between two financial buckets here.
Two buckets.
Yeah. If you don't, you're going to wildly mismanage your budget. Because one bucket is money you might get back. The other, it's gone forever.
Okay, let's unpack that. What's in the refundable bucket?
That's your security deposit. It's legally meant for a very specific purpose to cover, potential damages beyond normal wear and tear, or if you skip out on rent.
And there are rules around that, right?
Exactly. In a lot of U.S. states, it's legally capped, usually at 1 or 2 months' rent. And some places even require the landlord to give you back any interest it earns.
So that deposit is basically my good behavior bond, which means the non-refundable costs, the move-in fees. Those are the real cash traps.
That's it, precisely. Moving fees cover the landlord's administrative costs for turning the unit over. We're talking application processing, background checks, mandatory cleaning,
Utility connections.
all of that. And those application fees, say $30 to $75 per person, they're not coming back. They cover the cost of screening you in the first place.
That makes sense. But the real pain point I hear about is months or years later trying to get that security deposit back.
Oh, absolutely. That's where the nuance is.
How do you stop a landlord from just keeping it?
You have to document everything meticulously. Take photos, take video the day you move in. Note every single scratch.
Create a record from day one.
Yes. And when you move out, you follow the lease and state law to the letter. Given your forwarding address, demand the deposit back in writing. Many states have a deadline, like 14 or 30 days, for them to return it or send an itemized list of deductions.
And if they miss that deadline?
They might lose their right to keep any of it. Knowledge here is absolutely power.
Okay, so that's the insider tip. So, financially, what's a good target? How much should you have saved up for a local move?
The bare minimum cash you'll need is 3 times the monthly rent.
3 times.
Yep, that gets you the first month's rent, the security deposit, and those non-refundable fees. But, and financial experts really stress this, that's just your ticket to get in the door.
It's not the whole budget.
Not at all. You still need more for movers or a truck, and ideally you have a separate emergency fund, maybe 3 to 6 months of living expenses on top of everything.
Wow.
But the most important factor, honestly, is reliable income. A big savings cushion won't save you if you lose your job right after you move.
Stable income is the foundation.
Got it. Okay, let's scale up. Let's leave the local apartment hunt behind and talk about the big one. Moving your actual stuff long distance or internationally.
Right, shipping containers.
This is where things get really expensive.
Yeah.
Yes, and this is where the cost truly explodes and gets tied into, global economics. You're basically looking at 2 main options: full container load or FCL.
Meaning you get the whole container to yourself.
Exactly. And the other is less than container load, LCL.
And the cost difference for getting your own container, the FCL, how big is it?
Well, the optimistic range is somewhere between, say, $2,000 and $6,000.
Okay.
But global container rates fluctuate wildly. I mean, our updated figures for late 2025 show a 20-foot container could cost anywhere from $2,800 up to $15,600.
Wait. $15,000. Why is that spread so enormous for the same box?
It's a massive gap, and it's driven by very specific global factors. One is geopolitics that affects insurance and routes. But the other, and this is the one people miss, is container repositioning costs.
What's that?
If you're moving from a country that exports a lot to one that imports very little, say from the U.S. to somewhere in Oceania, you are basically paying for the shipping company to eventually send that empty container back to a busy port in Asia or Europe.
So I'm paying for its return trip.
That cost is baked right into your quote. It's why some routes are just shockingly expensive.
That context is so helpful. Okay, so what if I don't have a whole house to move? What about that LCL option?
LCL, the partial container, is definitely the cost-effective choice. You're sharing space, so you're sharing the cost. It averages around $1,600. Perfect if you're just moving essentials.
You mentioned delivery method is a huge variable. What's the real-world difference between port-to-port and door-to-door?
So port-to-port is always cheaper, sometimes dramatically so.
But there's a catch.
A huge one. Port-to-port means your stuff stops at the destination port, period. You are then responsible for everything else.
Oh.
Customs clearance, tariffs, bureaucracy, getting the container, arranging a truck to pick it up.
So saving $1,000 might cost me a week of my life, a ton of stress, and the cost of hiring a local broker and a truck anyway.
For most people, yeah, the convenience of door-to-door is worth the premium. The professional mover just handles all of that. And remember, the timeline is long either way. Overseas sea freight is 4 to 12 weeks.
Patience is key. Now, what about insurance? If I hire pros, I'm covered. If I go DIY, what's my biggest risk?
With pros, your items are insured. If you go DIY or use LCL without your own robust insurance, you're taking on a huge risk. Think about it. In an LCL shipment, if the entire container gets lost at sea, or if customs seizes it because of someone else's undeclared item,
Oh, no.
you might only get back a tiny weight-based reimbursement. You have to get third-party insurance for anything valuable.
That completely changes the calculation. Okay, let's pivot from physical stuff to the real regulatory quicksand.
What?
Money and taxes across borders. This is where a mistake means fines, not just a broken lamp.
This is definitely where we hit the regulatory quicksand. Let's make this real. Imagine our listener, let's call her Sarah. She's a U.S. citizen moving from California to the U.K. Her new job still pays her in U.S. dollars. Right away, she has 3 massive interwoven problems.
And problem number 1 is?
Tax residency. The first thing to get your head around is that leaving the U.S. does not, I repeat, does not automatically get you out of U.S. tax laws.
So she has to figure out her status back home.
And at the same time, the moment she becomes resident in the U.K., she starts building up a U.K. tax liability.
And I'm guessing the UK and US tax systems don't line up neatly. Which brings us to double tax agreements.
Yes, exactly. Double tax agreements, or DTAs, exist to stop you from being taxed twice on the same income, like her salary. But, and this is a huge but, they do not eliminate complexity.
How so?
Sarah will still have to file tax returns in both countries. She'll be taxed in the UK first, then she'll use the DTA to claim a credit for those UK taxes on her US return. It's a ton of paperwork, and the penalties for getting it wrong are severe.
Let's talk about the money itself. She's earning in dollars but living in pounds. That's got to be a risk.
Currency risk is a major hidden cost. Her actual spending power in the UK changes every single day with the exchange rate. If the dollar weakens, her UK life gets more expensive, potentially by thousands a year.
So how does she manage that?
She needs to avoid her standard bank for transfers.
Why's that?
They just have poor exchange rates and high fees. She should be using a specialist currency service or a multi-currency account. That lets her hold both currencies and lock in a good rate when she sees one, or even fix a rate for a future payment.
Proactive management. But what about just opening a UK bank account? Can she just walk in and do that?
It's incredibly hard. Banking is the ultimate catch-22. You need proof of address, a tax number, maybe an employment contract. You can't get a job without a bank account, but you can't get a bank account without a job and an address.
And what about her US bank?
She has to check with them. Many U.S. banks will actually restrict or even close your accounts once you become non-resident because of the compliance headaches.
And her investments, her 401k, her brokerage account.
This is often the biggest trap of all. Financial regulations are strictly jurisdictional. The moment Sarah is a UK resident, her US-based advisor is probably not authorized to give her advice anymore.
Wow.
And it gets worse. Some of her U.S. investment products, like certain mutual funds, might become incredibly tax inefficient under UK law. She could face a huge, unexpected tax bill.
So she can't just assume anything transfers over.
Absolutely not. And pensions are a whole other layer of complexity. The DTA decides if they're taxed in the country of residence or the country of origin. This is where specialist, dual-qualified advice is not optional. It is mandatory.
Okay, let's zoom in on that unique burden for Sarah as a U.S. citizen. Why is the U.S. system so different?
The U.S. is one of only 2 countries in the world, Eritrea is the other one, that taxes its citizens on their worldwide income no matter where they live.
It's based on citizenship, not residency.
Correct. It means Sarah has to file a U.S. tax return every single year for the rest of her life, even if she owes zero tax.
And then there's the reporting. FBAR and FACA. They sound like alphabet soup, but the penalties are terrifying.
They're administrative nightmares, basically. The Foreign Bank Account Report, or FBAR, requires you to report all your foreign accounts if the total value across all of them goes over $10,000 at any point in the year.
Just 10,000, and if you miss that filing, give us the visceral impact.
The consequence is catastrophic. A non-willful failure to file can be a $10,000 penalty. A willful failure can be 50% of the account balance.
Yeah.
Annually. It can wipe out the account.
That is just staggering. So compliance is absolutely non-negotiable.
It's not about the tax. It's about avoiding the penalty for simply failing to report.
And FTC is
Similar idea, but for higher asset thresholds, starting around $200,000 for people abroad. Again, it's about reporting.
So after all that reporting, how does Sarah actually avoid being taxed twice by the IRS if she's already paid tax in the UK?
She uses specific provisions. The foreign tax credit lets her subtract the taxes she paid to the UK dollar for dollar from her U.S. tax bill. Or she could use the foreign earned income exclusion to exclude a big chunk of her salary from U.S. tax altogether.
But both require filing correctly and on time.
It sounds totally unmanageable on your own.
It is. For someone like Sarah, getting advice from a professional who deeply understands the U.S.-UK tax treaty isn't a luxury. It's an absolute necessity. You have to pay for formal advice you can rely on. It's an investment against, existential risk. This has been a massive deep dive today. We've cracked the code on local moving cost-clarifying deposits versus non-refundable fees. We've put context on those wild shipping rates and weighed the real costs of port to port. And finally, we've gone through the absolute necessity of cross-border tax advice, especially for U.S. citizens facing that FBAR nightmare.
For a final thought, something for you to explore on your own. Beyond all the finance and logistics, remember this. When you move to a new country, you have to factor in the cost of temporary health coverage. Most public systems, like the UK's NHS, don't just grant you full, immediate access. There's often a waiting period, and your visa might even require you to have private insurance to cover that gap.
A temporary gap in health coverage is a potential financial black hole. Excellent point to end on. To our listener, take these steps, ask the right questions, and please, find a qualified cross-border tax professional. We really appreciate you joining us for this deep dive.